I'd rather die on my feet than live on my knees. You live in your fears, I'm living my dreams. I was just 17, focused on my game around 5-ish.
It's good to put faces to some people online. You know, we have a nice tight-knit community online, and being able to come and interact in person is a good feeling, and putting faces together and realizing that the impact is, you know, deeper than a computer screen. Thanks for coming.
I'm Dill.
Dill?
Yeah.
Cool, nice to meet you guys. How you guys doing? I gotta figure out how to get into this place first. So, all we see is a profile picture. What's going on?
What's up, brother?
How you doing?
Nice to meet you, bro. Such a pleasure.
What's your name?
My name is Ronnie.
Ronnie? Carmine. Nice to meet you too.
Bro, I just want to say, but thank you so much for what you do, dog. You
Appreciate
literally
it.
changed the way I trade, and like ever since I joined your course and everything that you taught, bro, dude, my trading has been like 10x.
Awesome, I really appreciate that. That's awesome.
amazing, bro.
It's a good feeling, right?
So thank you, yeah, bro.
Awesome, awesome. You're in the Discord too?
Well, I'm not really in the Discord. I'm his friend. I do
He's
real
just,
estate.
yeah.
So you shared a Discord with him. I appreciate you coming. Where are you from?
We're from Miami.
Oh, no way, you guys flew
Yeah,
here?
we're from Miami.
Oh, no?
You know, I don't like looking at that because it influences like
Right,
I trade.
right.
So I don't even like look at it. I just look at your pre-market plan. I compare it to mine.
That's good.
And, brother, when we have the same plan, I'm like, oh,
That's how you know?
amazing. Yeah, yeah.
What do you trade? How do you trade?
Futures.
Do you trade like what, like supply demand? Like,
Yeah, supply and demand, bro. Just like you.
Yeah?
Just like you. I literally just learned you, and I try to implement it. And bro, it works like a charm.
Awesome.
It's a lot of discipline also off the charts too.
Yeah, for sure.
Like back testing, bro. All that stuff. Reading psychology books, dude.
Psychology books are big. It helped me a lot, for sure. I still tap into them. Like if I'm going through a rough patch, I'll still tap into psychology books. For sure, so it helps me a lot. A lot of it's mental, yeah, but you gotta know what you're doing first. You know, you could be sharp mentally, but if you don't know what you're doing, it's still not gonna be good. But yeah, mental is a big part to it, for sure. Well, yeah, if you can't control yourself, you're done, you know?
So you would recommend like a psychology book? Like for
Yeah,
someone who keeps on making the same mistake?
Yeah, The Daily Trading Coach is a good book, or any book by Brett Steinbarger is really what I recommend. A lot of people like Trading in the Zone is another good one. The Mental Game of Trading. But I like any Brett Steinbarger. Yeah, I have all his books just in my office. So, and I tap into it. If I'm going through something, I'll literally scan through the book and tap back into it. And I already know what I need to know. It's just like I need to have like a refresh of it, like a light bulb moment. Like I'm lacking with something, and it like, yo, I know what I'm doing wrong. I just gotta now be disciplined enough for it. So, but once you have solid foundation, a good structure, it's a good feeling. It's a good business to be in. But a lot of people try to skip that foundation building process. They try to build the house from top to bottom, not from bottom to top. So you got to start it strong, have a good foundation.
Exactly.
So
that's why I love trading, bro. And that's why only a small portion of it are successful.
yeah, it's true.
Yeah.
That's good for us because the people that are, you know,
Exactly.
it's good to have you guys here. Appreciate you coming. A short squeeze basically means that if shorts are built in the market, so if I see a lot of selling activity or I know shorts are present, if the market goes against them, shorts have to buy to cover. So shorts squeezing the market higher. For shorts to exit, they have to be buyers. So the way I look at the market is shorts technically are buyers. If you're selling the market, you're technically a buyer because if you have to get out of your sell position, you have to buy. And if you're buying by stopping out or covering, that is just gonna squeeze the market higher. It's a short squeeze. So I'm looking mainly for where shorts are factored into the market, knowing where they're gonna place their stop losses or knowing where they're gonna be in a lot of pain and realizing that if we get above this level, if I'm a seller at this price and I see the market go against me and I'm down, I'm gonna have to cover. For me to cover, I have to buy. And if I cover and other people are buying after I cover, that's just gonna squeeze the market much higher. And that's when you get the crazy moves. It's usually short squeezes. Uncontrollable, just squeezes up.
I think you expect this many people to respond positively.
No, not really. It's pretty cool seeing all these people here. Yeah.
I personally know, like, you're doing a great job.
I posted about it maybe twice.
Yeah, trading, that's the thing about trading, gets lonely, man. I personally only know like 3 other traders.
Right, and it's cool bringing a community together outside of the screens and networking and talking with other people. My whole family's in the police force. Nah, I'm in College. Yeah. Alright, I went to College. And do you feel like some discipline from the Marines is like relatable to the market?
Absolutely. Like that's what I said. My wife's like, I don't know how you can sit here for 6 hours, 7 hours, because she'll go to lunch and I'm still there because I hear you in my mind saying screen time.
Yeah.
I have a cash account, so I'm waiting for the money to settle, right? So I only had, say, $2,000, and I made a couple of trades, and now I'm done until tomorrow.
Yeah.
So that was where, like, what am I doing? You know, I was asking, what can I do to kind of speed up the learning process?
Right.
But I think I definitely have to get out of the options because
for sure. I can't recommend it enough.
Not yesterday. I traveled the day before. I was in like 500 calls, and my mom was getting this halo taken off her head. I was in a trade, and it was like on my phone, and the app sucks, you know, on Thinkorswim. And I'm like, I'm not going red. I'm so sick of it. I almost blew this account up. I'm down probably $2,000 on these. Just the time to get it right, get the move right. But so anyway, that one ripped. The option on the contract I was in ended up closing at $8. And I was in at like $1.
So that's the benefit to it, but how many times?
I know that? Right.
You don't. How many times does it happen? You know, you can't look at that one time.
The other way, right?
Yeah. Well, no. What I recommend doing is trading the micro E-mini contracts. They're a tenth of the value of the standard full E-mini contracts, and your risk would be very small. Every 1 point or one handle on the E-mini is $5. So if it goes up 10 points, the most you're going to lose is $50 or gain $50. And it's all about the consistency. Like if you can prove to yourself that you can make $50 or whatever it is, then you know you have something that works, right? Yeah. Here we go. Just keep pushing. Here we come. Allowed me to drop out once I proved to them that I had some money. So it was like two and a half years in. I never peaked. I'm still not peaking, you know?
I hear you.
I'm not at my top speed yet. I'm still accelerating, so.
That's how you gotta be.
I just did it for fun, just for my friends. And then like a few videos blew up online and people, you know, gravitated towards InvestiTrade. So, you know, people find a lot of value out of it. So I kept doing it, you know? And you don't get a meetup like this with everybody coming up to me and saying how grateful they are, you know, off of stuff like that. So it's cool.
No, you changed a lot of lives, bro.
I appreciate it, yeah. Businessman, he'll go where. You like that? There's one. I got that in the caption book. Oh, that's cool. That's really cool. There's a lot of Section 8 comedy going there, right? I feel like Ohio people are heavy in for sure. That's good. Appreciate you coming here. Yeah. Oh, Baltimore, you drove up here? Cool. All right, if anybody has any questions, I know probably everybody's gonna have a question, but we'll try to go through as many as we could in a short amount of time. Whoever raises their hand first.
And don't be scared. There's no such thing as the
there you go.
question.
What's the biggest difference between a trader like me who burns money and a trader like you?
I mean, the biggest thing is risk management, because when you have a solid risk management parameters, there's no such thing as burning money, at least a large amount of money fast. I mean, maybe your money will deplete a lot slower if you have solid risk management, but in that process, you'll be able to like pick up on what you need to cut out and what you need to scale up that's working for you the best. So I would say risk management, because a lot of people blow up because of shitty risk management, you know? I was talking to somebody in here, they had a $17,000, right here. They lost 17K, you know, like there should be no such thing as losing that large amount of money. It's a lot of money to lose, especially when you're in the learning phases. You know, when you're learning, your losses have to be super, super small. Not blowing up 17K, and how long was that? I don't want to put you on the spotlight here. It was 1 day, yeah. The biggest thing is risk management. If you can protect your losses when you were wrong, you will stay in this game for a long time. Like if you look at any successful traders' losses, they're probably 2 times less than their wins.
If you're making enough money, you don't have to do this.
I don't think it was ever about the money aspect.
Yeah.
During COVID, especially, there was so much saturation in the learning, environment for trading, but a lot of people were preaching the wrong things. They were preaching strategies and, things like that, and they were neglecting the whole aspect of risk management and the things that people often overlook. So, you know, me and Carmine basically saw a problem in the learning space, and so I don't think it was ever the money aspect. It was more so that there was a lot of saturation and a lot of, you know, things that were taught.
So I was talking about this with a few other people here. So let's say you enter a trade and it goes your way and you hit your first take profit, so you scale like 50%. But then we have this problem where it goes against you. Decide to hold to your next take profit and it starts going against you, and then you stop at break even. Or when you decide to take profit for both contracts, or your full position at that first take profit, and then it ends up going to your second take profit. So you end up missing out on profits. And like we have this dilemma, like how do we decide whether we should hold, whether you should continue? Is it?
Yeah, it's a good question. So the first thing I gotta say to that is don't try to be perfect. A lot of people seek perfection. Like they try to seek every single move and extract every single dollar out of the market. And if you go for that, that's when you're really gonna struggle, because not only you're gonna be making stupid decisions by getting in and out of a trade when you shouldn't be, but also you're gonna get in your own head and it's gonna be a domino effect for future trades. So you have to look based off of your own data. It's a double-edged sword, right? If the market keeps going up after you sell, you're gonna be so upset that it kept going up, and you were gonna be mad at yourself that you sold early, call it. But maybe it was at your target, so it really wasn't early. So it's based off of your data, I would say. If you see the market continuously running without you after you sell early, then maybe scale out 50% of it or 75% of it. Hold runners. Maybe don't adjust your runners to break even, because break even really doesn't invalidate your thesis too much. I'm not a big believer in adjusting to break even with those rules, because break even on the chart really doesn't prove you wrong, right? Exactly. I mean, I have rules where I adjust to break even for certain trades like scalps, but for a trade like that where you're going for a larger move, adjusting your stop to break even really doesn't prove you wrong, or it doesn't invalidate your thesis. So I would say it really depends on your data. If you notice the market keeps moving in your favor, then maybe scale out, adjust your stop loss, and then capitalize on that larger move. If you notice maybe 60-70% of the times it doesn't, then maybe sell 100% at your target. But it really depends on your data and everybody's trades. You know, everybody trades differently, so it's hard to correct that and try to seek perfection when it's really never gonna happen.
Did you guys see that supply and demand for you doesn't work as much, and that's why you kind of pivoted to levels, or is levels for you now kind of like your new thing? So I kind of feel like at one point in time it was kind of like the bread and butter, and now it's like, oh, I'm gonna start using levels now because it seems like it's being respected more. And
yeah.
My second question is, how did you guys develop like contrarian thinking in terms of like the trade pieces?
It's the core foundation is supply demand, and then you combine other things to conform it. And depending on the market conditions, like uptrending markets, you're gonna have demand zones pull back into support work better than downtrending markets. So it's really about understanding the conditions we're in. If we're in a balanced market, then shorting the highs and buying the lows will work best, instead of going for, let's just say, a breakout type of trade. So it really depends on the market, and I found the market right now, with how the volatility is kind of picking up, is a lot easier to trade short term with reading the volume and reading the order flow and using supply, demand, and key levels around it. So it really depends on the market, and it depends on the conditions and adapting with it. And then the second question, contrarian. So everybody's buying. Tesla just broke out above $200. I'm gonna get long because that resistance level broke that everybody in here could see. If everybody's buying it at that level or whatever, selling it at a specific level, I know the chances of it working is gonna be slim. Right, so I like going against the crowd and not following everybody. And for me, reversals are what I prefer to trade, because I know that when somebody's buying and someone's gonna get stopped out of a position, I know that's where the best edge will be, instead of buying when everybody in this room is also buying.
So you're making an assumption pretty much, and because that assumption pretty much works out is why you take that trade.
Right. I mean, if you were to look at all my trades, and you can go back, everybody in here is in the Discord, you can literally go back and look at every single trade that I've taken, because every single trade that I've taken personally has been posted in the Discord, in the intraday commentary. You can go back and look at my setups and see, why did Carmine enter there? Why did Carmine exit there? Was that a good move or was that a bad move? And I guarantee you, if you look at why I enter every single setup, they're all similar, and I guarantee you will find patterns that you can reverse engineer and develop it into your own trading. Because every single entry and exit that I take is so systematic that it's just repeatable, and I'm just looking for it on a daily basis. As far as being On the opposite side of the market, I find the best edge comes from when people are exiting for a loss, and when they're in pain is when the greatest edge comes to be present in the market. It's not buying Tesla as soon as it breaks above a resistance level that everybody's just marking a daily high on their charts. Like, there's no edge in there. If anybody could do it, the chances of it happening is going to be slim. But if not a lot of people do it, or not a lot of people are aware of it, then the chances of it happening is going to be higher than everybody else doing it.
Do you suggest me walking away, taking a break for a few days, or sizing down? Also, when Dylan and Carmine, you guys take a big red day, how do you handle it? What do you do afterwards?
So my biggest thing, I'm a big believer that you should standardize your risk. Okay, and a lot of people argue against this, but I'll explain against the arguments. I personally, on a month-to-month basis, risk the same amount of money for every single trade that I take. Okay, and one might argue, oh well, what if it's an A+ setup? When you want to size up on your A+ setup, you're assuming that that A+ setup is invincible. It's not going to lose money. Okay, take 10 trades, 3 of them are A+, right? And you risk 3-4 times as much on those 3 trades. If you lose those 3 trades, you're now off sides where it's going to blow the other 7. Even if you win the other 7, right? You have a 70% win rate, but you're down money, right? And during times of underperformance, which every single trader has, I don't care if you've been trading for 20 years or 2 years, you're going to go through times of underperformance. By standardizing your risk on a monthly basis, you're allowing for the bigger data set to absorb those times of underperformance. The first thing to do is figure out an amount that you're totally comfortable with. Let's just say $200. Every single trade you take, whether you're trading S&P or crude oil, it doesn't matter, you're risking $200. Okay? And what that's preventing is for you to take 1 step back and 3 steps, or 1 step forward and 3 steps back. Okay? Because as long as your risk parameters are favorable, right? 2-to-1, 3-to-1, 4-to-1, over time, your win percentage is going to take care of the losses. Even if you have a low win percentage, 35, 40%, you're still going to come out on top with a higher probability as opposed to someone who's risking $1,000 on one trade and then $3,000 on the next. So the moment you skew your risk amounts, you're off sides, okay? So that's my thing on that. So for me, I really don't have big losses because every single trade is an amount that I am totally comfortable with. So even if I have a month where I'm, 30% win rate, it's a very manageable month where it's a paper cut instead of having a massive loss blow the last 20 days of profits. So that's what I always recommend doing. People would argue against that, but I stand by that. My risk amount for January is $1,000, okay? I do well. February, $1,200. I do well. February, or the next month, $1,500. I do well, $1,700. So that's me scaling up based on monthly performance. If I do poorly, going from 1,000, next month, 800, do poorly again, 600. Do well the next month, 800, right? So that's where I scale on a monthly basis.
30 minutes before the market's open, I have my levels set, and I'm really not doing anything on my computer 30 minutes before the market's open. I already have the levels I'm watching, and now my objective is just to wait for the market to open up and wait for new information to be presented to me. So as far as 30 minutes before the market open, if you want to develop your levels then, you could do that. But as far as my routine before the market, I don't really have a solid routine because I'm waiting for new information that I don't currently have, and I can't get that until the market's open. A level could form at 3 o'clock in the afternoon. A level could form at 8:30, an hour before the market opens up. So I'll mark them on my charts whenever they form, and I'll keep them there, and I'll let them be on my charts until the market tests them. If it doesn't react to them or it doesn't respect it, I know it's not a level that I should have on my charts.
That allows you to be 1 step ahead because a lot of retail traders will wait for a move to occur and then look for levels.
Yeah.
Right? And if you do that, your risk reward is now skewed because a lot of the move has probably already happened. If you have the levels preset on your chart before the initial move occurs, you're 1 step ahead so that when the market does go up there and test that level, you already know what you want to see and what you're looking out for.
What else are you looking for when
it depends.
Name is gonna hit a level, and you said this is about to hit my level?
Depends on how you trade.
Yeah.
There's a million different strategies out there, and there's.
I'm trying to absorb from you guys.
Yeah.
I'm saying, what do you look at there? If a level is about to hit.
I'm mainly looking for volume. Volume confirming the direction, validating if my level is strong or not, and validating if participants are buying or selling around my level.
Relative strength, relative weakness, right? If you are looking at, say, S&P and the NASDAQ, and the S&P is relatively stronger, and it's coming up to a level, and it fails to break that, right? That's not good for the overall market, because you would assume that the relatively strong name will be able to to break out of the resistance, right? So there's just, basically you're looking for context to then use to come up with other pieces of context that are all going to combine. There's levels that we have on our chart that the price hits there, but we don't do anything with it. Doesn't mean that you're going to 100% trade around that level, right? Instead, you're looking at pieces of confirmations around that level that you can then use to kind of get an idea of where you believe the market goes next.
Thank you both for everything you guys do for the entire group. Carmine, you know I pester you a lot of my questions, so I'm going to refresh your memory on a few things. I asked you many months ago about if you ever enter trades at the market open. You said no. Over the years I've learned, again, about 50-50 is not worth the risk. And then I listened to your YouTube lecture about the now, where order flow is instantaneous information, it's not lagging, so use the now. What if you have, with the now, you have good setup, the confirmation signals that you've taught us, basing, retracement, etc. Which one is it? Do we stay away from open trades, or if the now is good, can we use that information and enter at the market open?
You take trades whenever you find the opportunity, right? Like some traders may only trade an hour before the market's open and don't trade the normal cash session. Some people might only trade the first half hour of the market being open. So everybody is going to define opportunities differently. And I don't really agree with forming rules or structuring your trading in a way, because the market's unstructured. So trying to structure things properly is kind of going against the market, because the market is unstructured. So you're trying to conform something that's not non-conforming. So be open to any possible scenario. The market spits out information, and we have to go with that information and not ever go against it, and be aware of the opportunities and how you define the opportunities. And whenever you find an opportunity, just take it.
Even if it's the open, if the signal's there.
Absolutely.
Yeah, I don't think time of day matters per se. With me, as long as I see that my edge is present and there's good risk parameters, I don't care if it's 2 a.m., 2 p.m., 8 a.m., 8 p.m. I don't care if there's news coming out. That's me personally. My boss, the owner of my firm, always says that, as long as you have an edge and you are disciplined enough to have, risk management, and I would rather 10 out of 10 times, 100%, I would rather take a loss on a trade as opposed to see a good setup that has my edge present, see one, let it go without me and it work. I'd rather try it, take the loss, as opposed to see it work without me, 100%.
Yeah, so my question is kind of a mixture of the pre-market as well as the independent, because so I trade options. My thing is, when you see your setup kind of go without you in the pre-market, how do you adjust your strategy, your mental to like kind of accommodate for that complete deviation in your plan?
There's two things. I don't know if I should be telling you this if you're a degenerate, but there are options during extended hours. SPX trades.
I've never really traded in like pre-market hours or after hours.
You can.
Yeah.
If you have a solid setup and your edge is present, the whole nine, take it. Right? As long as you are, like I said, disciplined enough to manage the risk and you think that you have a good edge, take it. Okay? The other thing is there's always opportunities in the market. If you miss one that occurs at 4 a.m., 8 a.m., whatever the case may be, don't dwell on that, right? Focus on the present and the future, okay? Don't say, oh, well, it did exactly what I planned on it doing and I missed it, right? The moment you do that and dwell on the past and let your emotions, be vulnerable to that, it's gonna screw you up, okay? So there's always going to be opportunities. It might not be every day or every hour, but there are going to be other opportunities to capitalize on.
I just appreciate everybody coming. It's good to put faces to some people online. You know, we have a nice tight-knit community online, and being able to come and interact in person is a good feeling, and putting faces together and realizing that the impact is, you know, deeper than a computer screen. So I appreciate everybody coming, and we'll definitely be doing this again.
Yeah.